ini juga mendapatkan banyak ilmu dari luar negeri karena banyaknya profesor dari luar negeri yang juga membagikan ilmunya untuk kami. Didukung dengan semua hal tersebut, saya yakin tantangan tersebut menjadi mudah.
Pada tingkat internasional, program S2 Ilmu Ekonomi memiliki 12 mitra aktif dari berbagai belahan dunia, Australia, Jepang, Belanda, dan Amerika. Kerjasama internasional ini mampu meningkatkan kualitas pengajaran dan penelitian. Dalam proses perkuliahan, mahasiswa tidak hanya diperkenalkan konsep dan teori ilmu ekonomi, namun juga dibekali keterampilan lain yang bisa menunjang karir sebagai analis ekonomi, peneliti, dan akademisi.
Kuliah di S2 Ilmu Ekonomi Universitas Indonesia menjadi kesempatan emas sekaligus tantangan bagi saya. Didukung dengan kurikulum yang baik dan tenaga pendidik yang merupakan para ekonom ternama di Indonesia, membuat saya dapat mengaplikasikan ilmu yang saya peroleh di bidang pekerjaan saya saat ini, yaitu sebagai staf analis, pengawasan kebijakan pajak dan kepabeanan dan cukai. Menjadi keluarga besar Fakultas Ekonomi dan Bisnis Universitas Indonesia menjadi kesempatan yang tidak akan saya lupakan dan saya bangga.
Tahun pertama saya di PPIE Universitas Indonesia, saya dilatih untuk berpola pikir yang kritis, analitis, dan juga independen di dalam menganalisis ataupun menjawab permasalahan perekonomian. Kemudian, tahun kedua saya di ISS University Rotterdam, saya diberkahi wawasannya, dibukakan matanya dalam hal ternyata ilmu ekonomi dan juga isu-isu ekonomi ternyata ditinjau tidak hanya dari satu sudut pandang saja ataupun dari school of thought yang konvensional saja. Tentunya hal-hal dimaksud berpengaruh signifikan dan juga berpengaruh positif di dalam mendukung karir profesional saya di dunia kerja untuk lebih baik ke depan. Terima kasih.
Program studi S2 Ilmu Ekonomi didirikan pada 1993, berada di bawah naungan Fakultas Ekonomi dan Bisnis Universitas Indonesia. Program studi S2 Ilmu Ekonomi memiliki visi menjadi pusat pembelajaran ilmu ekonomi jenjang magister yang bereputasi baik di tingkat nasional dan di Asia, sehingga berkontribusi terhadap pembangunan Indonesia dan masyarakat global.
Tujuan dan pengembangan program studi S2 Ilmu Ekonomi ini adalah untuk menghasilkan para tenaga ahli dan profesional yang andal dalam beradaptasi dan melakukan kajian ekonomi untuk menjawab kebutuhan akademik, pemerintahan, dan sektor swasta, serta menghasilkan lulusan yang memiliki tanggung jawab sosial.
Untuk mendukung pendidikan ilmu ekonomi yang berkualitas tinggi, kontekstual, dan sejalan dengan perkembangan ilmu ekonomi global, kami melibatkan dosen-dosen berkualifikasi profesor dan doktor yang terbaik di bidangnya.
Good morning, distinguished ladies and gentlemen. IMF Senior Resident Representative for Indonesia, Mr. James P. Walls. IMF Senior Economist for Asia and Pacific Department, Mr. Yan Carrier. Dean Faculty of Economics and Business Universitas Indonesia, Mr. Teguh Dartanto, PhD. Head of the SBI and Chairman of the PIC International Corporation, Mr. Muhammad Edi Purnawan, PhD. Secretary of Graduate Program in Economics, Mr. Ruslan Nasruddin, PhD, and responsible all the participants that come from offline and online. My name is Doti, and it is an honor for me to be here as your Master of Ceremony. Welcome to PPIC International Lecture Series 5 with the topic Economic Outlook. Before we start the lecture series, together we will hear the Indonesian national anthem, Indonesia Raya. Ladies and gentlemen, please stand up. Ladies and gentlemen, you are invited to return to your seat. Dear all participants, ladies and gentlemen, to start our agendas today, together we will hear a welcoming speech from Dean of Faculty of Economics and Business, Universitas Indonesia, for Mr. Teguh Dartanto, PhD. Time is yours.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Peace be upon us all. Om Swastiastu, Namo Buddhaya, salam kebajikan untuk kita semuanya. Distinguished speaker, Kim Walls, a senior resident representative IMF Indonesia. I don't know this, but Jan Kari Follow, IMF senior economist for Asia and Pacific Department. Bapak Muhammad Edi Purnawan, head of the BSP and chairman of PPIC International Corporation that who attended online. Dr. Telisa Aula Valiante, our faculty member and the moderator for today lecture series. Student, fellow lecturers, ladies and gentlemen, both in offline, in person here, as well as in online. It is a very important event that we have a guest from the IMF. And this is very important topic about discussing about the future of our economy, especially in 2023. Next years, we will face the further global challenges and uncertainties. Global growth has been hurt by the pandemic and is not yet the accentuated and propagated first effect of the war. Russia-Ukraine is still continue. That we all expect the end, but I think it still continue until 2023, along with the high inflation in a significant part of the world, especially in developed countries, and slowdowns in China economic growth. The uncertainty of the pandemics resulted is also still emerging in lots of parts of the globe, making the complete reasons for the world fear of the upcoming global recession. Many countries in this region, including Indonesia, are grappling with the issues despite the ASEAN's growth has been strong in the last 2 years. Yet, export-driven growth is no longer complete when many economies face the rise of the U.S. term of trade, and Asia is no exception today. I think next year will be end of the commodity boom, especially for the resource country like Indonesia. And gentlemen, the difficulties and uncertainties must be met with the caution of the cooperation of the nations between agencies, especially the government and the private sector, with the support of the community, including us, the university. Thus, the understanding the nature of the uncertainty is key, and the today's lecture, I believe, will bring fresh and prominent views on it from our distinguished speaker. This is a fresh from the first hand from the IMF people. We hope that we, as the academic community, can help and support the government formulates well, quickly, and suitable policies with effective execution in dealing with this concern. We hope that the general society must not suffer as a result of the global uncertainty. So this lecture, I'm sure, will bring insight as well as a critical assessment of how the strength of the current Indonesian economic growth must be taken care of. Key issues have been concerning us, such as the potential risk of the global recession that's come from the trade and the financial links for us. Also, the increase in the cost of the borrowing as a result of the strategic response of many central banks to the U.S. interest rate increase, including Indonesia. I think that our central bank already increased 3 times of the Bank Indonesia rates. Ladies and gentlemen, nevertheless, we also noticed that Indonesia has been embarking on some important steps on the fundamental structural reform, such as the issuance of a law on job creation that simplifies the bureaucracy for investment, and the law on harmonization of the tax regulation that set the basis for the broadening the tax base in the present time for the government's budget deficit and the demand for financing. This and other fundamental reforms toward the green economy have been happening, and they need to be put forward. I think the Indonesia, also our fiscal, until now is still positive surplus. We expect this is deficit 4.5, but I think we will reach less than 4.5. And next year we will come back to the maximum 3% of the deficit. Hopefully Indonesia will survive and have the strong fiscal and macroeconomic condition. I'm sure that the lecture on the global Asia Pacific Indonesia Economic Outlook of the PPIC International Lecture Series number 5 will reach in collaboration between Faculty of Economic and Business University Indonesia and also Universitas Gadjah Mada and also the Indonesian Economic Association will benefit us in the term of knowledge, knowledge sharing and understanding the potential and the risk of this reform under the current global challenges and uncertainties. I hope you all enjoyed the lecture and hopefully having the fruitful discussion with our prominent expert from IMF. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you very much, Mr. Teguh, for the welcoming speech. Ladies and gentlemen, to lead the next session, we kindly invite the moderator to this event, Dr. Telisa Aulia Valianti. Without further ado, Mrs. Telisa, floor is yours.
Okay. Good morning.
all. Thank you very much for the opportunities today as the moderator in current discussion about economic outlook. Yeah, we have a very prominent speaker here from IMF. Yeah, and we first say thanks to IMF that also in this international series collaborating with ISEI. Yeah, Pak Teguh has also said that this is one part of the international lecture series from Indonesian Economics Association or ISEI in Indonesia terms, yeah, and also held by PPA Prodi. Thank you to the Secretary of Study Program of Economics, yeah, Pak Ruslan, and also all of the participants here, Pak Wadik, Pak Arif. Good morning also, and of course for the speakers, yeah, we have the prominent speakers here, Mr. Jan Karir. Sorry for if I missed, yeah, the name is rather hard, yeah, Mr. Yan and also Mr. Jim or Mr. James Wall. Yeah, we have two prominent speakers here. I will invite for both of our prominent speakers today, for Mr. Yan and also Mr. James. Please comes we can have please give the applause to our prominent speakers. Yeah. Yeah, I'm very happy today. Yeah, there are two gentlemen here. Yeah, and I'm the gender participation. Okay, thank you. I will read the CV. Yeah, of yeah, of course. First, we have Mr. Yan. Also, I'll call you Mr. Yan. The spell Yan, the pronunciation. Okay. Mr. Yan is a senior economist in the IMF Asia and Pacific Department, where he contributes analysis on regional issues and in the desk of economists covering Indonesia. And his research interests span topics in the international macroeconomics, yeah, and also digitalization. Oh, it's very interesting, yeah, about digitalization. You also have many research about the digitalization with focus on emerging markets and their policies. Yeah, and prior to joining IMF, 20 in the 2012, yeah, so about 10 years, yeah, 10 years in IMF. Okay, so I think that you already many experience, yeah, about IMF and how about the country that becomes the research of IMF. And he was an economist at the Central Bank of Chile in Santiago. Yeah, I think Chile is very interesting countries, yeah, because of the commodity dependent, yeah, at copper, yeah. Maybe that we can have a lot lesson learned, yeah, about Chile. And the field of expertise of Mr. Yan is in monetary policy, macro financial issues, and international macroeconomic. And Mr. Yan has been published, yeah, he see in Google Scholar or in Scopus, yeah, there are many research from Mr. Yan also, yeah, about working papers and IMF books, yeah. There are many research here. You can also search, yeah, in Google. One of them, for example, shipping cost and inflation. Oh, I think it's very current issue, yeah, about shipping cost. And also macro financial causes of optimism in growth forecast, because this is done majorly from the graduate studies, yeah. One of the task is also to read the journal working paper. So please, yeah, read the journal of working paper from Mr. Rian and Mr. James, yeah. It's many interesting paper here, yeah. And also, for example, about U.S. monetary policy normalization and global interest rate. And some country reports, for example, Indonesia Article 4 consultation 2002, yeah, and about yeah, other countries like Guinea, yeah, in Africa, and also Argentina first review under the standby agreement. And there are also a lot of the IMF direct blog posts and also IMF occasional papers you can see in the website, of course, yeah. Okay, please for the first time, Mr. Yan, and then after that, Mr. James. But I will read the CV of Mr. James after the Mr. Yan presentation. Please, Mr. Yan, for 25 or 30 minutes presentation. Thank you.
People online? Is that- Hello? Yeah, you can hear me. Thanks very much for having me. It's a real pleasure to be with you today. The report that I'm going to be speaking about is our regional economic outlook for Asia and Pacific. The report was launched just last week in Singapore and again yesterday in Delhi. So it's fresh off the press. This regional economic outlook is a report that we put together once per year. It comes out along with the World Economic Outlook, and it's the IMF's chance to tell the story of how we see the outlook for Asia and Pacific. You know, the story behind the numbers you get more frequently as part of our World Economic Outlook. So I will the slides are we're having trouble with the slides. We can wait for that a little bit. Yeah, that's perfect. Okay. So the title of the report is called Sailing into Headwinds in this round. This is how we see the factors in the outlook. This is not working. Where am I pointing in the right direction? Okay, slide. Oh, okay. Could you skip to the next slide then, please? Thank you. Yes. This is better? Oh, that's much louder. Okay, good. So the three headwinds that we refer to in the title of the report, two of them are coming from outside and one of them are coming from within Asia. So let me start the presentation by going over those and I'll explain how we see them fitting into the outlook for Asia. Next slide, please. Thanks. The first headwind that is facing the region is global financial tightening. You can see how on this slide, we show how the forward curve for monetary policy rates in the United States and in the Euro area have been revised up very substantially over the last year. Since as recently as last December, market expectations and our expectations were for monetary policy in the advanced economies to stay relatively loose over the medium term, with policy urging to a long-term level very gradually over 2 or 3 years. That view has radically changed as inflation in the United States and Europe has surprised repeatedly on different reasons, but the response of the central banks has now converged to one of much tighter monetary policy stances. And so we now expect the real policy rate in the United States, shown in the middle chart here, to be quite substantially positive and contractionary through 2023 and 2024. So this is very different than what was expected as recently as just 9 months ago. So that's the first headwind. Next slide, please. So with the increase in policy rates, can we go to the next slide? With the increase in policy rates in the United States and in Europe, we've started seeing increases in financing costs facing the Asia and Pacific economies. On the left-hand side, this is the change in the policy in the sovereign yields on debt instruments denominated in local currency, and on the right-hand side for spreads in US dollars. In terms of local currency spreads, we're seeing yields rise more sharply in the advanced economies. We're substantially tighter than they were for the 5 years before the pandemic. In the emerging markets, the increase has been a bit more modest, and rates remain fine or even below, in some cases, the pandemic. So we see financial conditions in the emerging markets still being relatively favorable, despite the tightening that we've seen over the last 9 months. In terms of dollar-denominated spreads, the big increases have really been contained to Papua New Guinea, Mongolia, and Sri Lanka, where the yields has been very sharp. For the big emerging markets, including Indonesia, the increase in MB spreads has actually been quite modest in the last year, by about 50 to 100 basis points. In relation to previous Fed tightening cycles, we see this as a relatively small increase in external financing costs for the time being. Next slide, please. The picture for capital flows facing Asia, I think, is a bit mixed. As If you take the region as an aggregate, you can come out with a conclusion that capital outflows in the year to date for 2022 have been relatively large in the sense that they're comparable to the net outflows that we saw in previous episodes of stress, including the taper tantrum and the onset of the COVID-19 pandemic. But when we look at the country level information, we actually conclude that these capital outflows have been quite focused on a handful of countries and are not yet showing any kind of generalized pressure on capital accounts across Asia. Next slide, please. Okay, that's the first headwind, financial tightening. The second headwind that is facing the region is coming from Russia's invasion of Ukraine. The main transmission channel that we see being relevant for Asia and Pacific is through global commodity markets. We saw after the invasion very synchronized and very low in global commodity prices, affecting pretty much all commodities. Since then, we've had quite a substantial reversion of agricultural commodities and of crude oil, while coal prices and natural gas prices have stayed very high. So I think at this point, standing in October or November 1st now, we have more heterogeneity in the commodity picture. And I think the emphasis that we're trying to put on this concept is that commodity prices have been very volatile and are expected to remain very volatile. It's very hard to plan for where these commodity prices will go in 2023 because the picture as the situation in Ukraine evolves. How is that translated into the external accounts of Asia and Pacific countries? By no means a homogeneous picture. Some countries seeing very large negative revisions to current account balances for 2022, including the advanced economies that import a lot of commodities like New Zealand, but also some of the big emerging markets like the Philippines. On the other hand, we have the net commodity exporting countries in Asia, including Indonesia, where we've had a lot of revision to current account balances. So this commodity price developments has actually been a windfall for the country. So by no means a homogeneous picture across Asia. Looking forward, how will the war affect the region and the outlook? We see the main channel in 2023 likely to come from weaker external demand in 2022 has actually held up much better than we had expected for Asia, with exports to the US and to the Euro area still growing at double-digit levels for most of 2022, despite those economies slowing down substantially. But we have started seeing in the data, over the last 2 or 3 months, orders for Asian manufacturers have entered in contractionary territory and starting to slow down. So we expect those headwinds affect the outlook and weaken the outlook in 2023. Next slide. The third headwind is coming from within Asia, and it's the sharp and uncharacteristic slowdown of the Chinese economy. On the left, I show how we've revised down the path of growth for China over the last 4 installments of the World Economic Outlook. This has been a very substantial downgrade to growth in 2022. Since as recently as April, we've downgraded growth by 1.2%. We're now at 3.2% is the expected growth rate for this year. Much below our previous estimates and much below the authorities' target for 2022. We expect next year, and this is indeed driving our regional growth going above 4% in 2023. But really, this rate of growth in 2022 is very uncharacteristic. It's the third slowest rate of growth since 1977 for the Chinese economy. It's much slower than what the region has grown accustomed to having. And we see that having very important spillovers to the rest of Asia. So in the report, we provide some empirical estimates that find that when China slows down by 1 percentage point, this leads to a slowdown of 0.3% in the other Asian economies. So this is factored into our forecasts. Next slide, please. So those are the 3 headwinds. How does this all shake out in terms of the numbers? This table summarizes our forecasts for Asia. You can see as a region as a whole, we're seeing Asia slowing down from a rate of growth of 6.5%. It was quite strong in 2021 at the peak of the COVID recovery, slowing down to 4% this year in 2022. That's substantially slower than we were expecting in April. And it's also slower than we were expecting recently in July. So we're talking about a sequential downgrade for the 2022 forecast. We see an uptick to 4.3% for the region next year in 2023, but this is not representative. This is largely capturing that path for Chinese growth. The majority of countries in the region, including Indonesia, we expect to actually see a further slowdown of growth in 2023 with respect to 2022. One thing I think to note is Asia continues to outperform the global economy. The World Economic Outlook from this round is extremely somber. We're describing a majority of countries where their economies will feel like they're in recession this year, if not actually in technical recession. Wage growth will be low, growth will be low, and so they will feel like they're in recession. This is a very somber global economic outlook. In that context, these growth rates for Asia are better than the rest of the world. So Asia remains a relative bright spot for the global economy. Within Asia, ASEAN is growing faster than the rest of the region. So ASEAN is a relative bright spot within Asia. And within ASEAN, Indonesia is growing faster than the other countries as well. So I think we need to keep these numbers in context. We are downgrading growth, but in relative terms, Asia does remain a relative bright spot in the global economy. Next slide, please. What about for inflation? Well, we've seen a return of inflation in the global economy over the last 2 years. This has happened more recently in Asia. Of course, in 2021, we had inflation in Asia largely running below central bank targets, bucking global trends. In 2022, that picture started to change. We've noticed a pickup in headline inflation that's now above central bank targets in the vast majority of countries across Asia, including both the advanced and the emerging markets at this point. So inflation rates that are still below what we're seeing elsewhere, but also worryingly rising above central bank targets. How has the forecast evolved? Well, you can see for the US and for the other G7 economies, we've been making very large revisions to our inflation forecast over the last 4 World Economic Outlooks. That was not the case for Asia. We had a view that inflation in Asia looked more benign in past WEOs. That is starting to change in this report. So our forecasts for Asian inflation are now that it will reach above 4% on average for the region, peak at the end of this year, and return to central bank targets over the course of 2023 and early 2024. Next slide, please. I think one of our main concerns for the outlook for Asia and Pacific involves the medium and longer term. We've raised this issue of pandemic scarring in past reports, and we're doing so again in this one. We have a full chapter dedicated to this question. What is driving it? What can we do about it? The stylized fact that I present on this slide is that if you take the output that was expected for Asia and Pacific in 2024 at the time before the pandemic, and you compare it to what we're expecting for that same period now, that has been downgraded by about 9% on average. So that's a very substantial downgrade. For many of the emerging markets, it's actually more than 10 percentage points on the level of real output. That affects all sorts of policy questions, including levels of debt, levels of reserves, long-term strategies. So we think this is a very important concern. It's largely reflecting downgrades to the perspective for investment in the region. So we're seeing substantial underinvestment with respect to pre-pandemic projections. And it's affecting the tourism-dependent economies most of all. So I think that's a very important issue that we see a need for a broad structural reform push to compensate for this. And we'll talk about that a bit later. Next slide, please. Okay, that's all about the baseline. What about risks to this outlook? The global economy is extremely uncertain at the moment. We're making large revisions all over the globe. So I think it's a time where we really need to be conscious and planning for what happens if we get downside risks materializing. Next slide, please. So in the short term, we see the main risks stemming from the intensification of those same 3 headwinds, right? So the global financial tightening, the war in Ukraine, and the slowdown in China. So we run a scenario where we intensify those 3 factors, and we study what would be the response of the APD countries to this type of a downside scenario. What we find is that for 2023, growth in it would be about 1 to 1.5 points lower, with some heterogeneity across the region to account for trade and financial linkages. So still positive growth for Asia in this downside scenario, but certainly a scenario where policy would have to respond differently, have less room for maneuver. Next slide, please. In the longer term, we've written a full chapter in the report on economic fragmentation. We're starting to see worrying signs that are already appearing in the global economy that this trend is underway. A first thing has been the spike in trade-related uncertainty that has happened since 2021. We show estimates in the report that we think this will dampen investment across Asia and in the global economy as well. Another worrying factor that we point to in the report is an increase in the number of harmful trade restrictions that have emerged in 2021 and 2022. And we think this has been accentuated after the invasion of Ukraine, with a lot of countries responding to the commodity price shock through protectionist measures. So we're concerned about that. We think that's going to make it harder for trade relationships to remain open and healthy. We run a simulation in the chapter where we look at the long-term effects of what were to happen if this trend were to continue and deepen and the global economy were to fracture into two separate trading blocks. And what we find there is that that would have quite a large negative impact on GDP growth at a global level, but that Asia stands to lose more than the rest of the world in this scenario. And the intuition here is that the growth model across Asia for the last 2 to 3 decades has really been one that's focused on export-led growth with very strong trade linkages within the region and abroad. And so a scenario in which those trade relationships start to break down, start to get impeded, would be one where growth in Asia would be substantially lower. Next slide, please. Okay, so what are the policies that we're recommending to our membership in view of this outlook? Next slide. The broad scheme of things is that we see the vast majority of countries in Asia starting to withdraw the exceptional support that was deployed during the COVID-19 pandemic, both in terms of monetary policy and in terms of fiscal consolidation. This applies to every economy except for China and Japan, where again, the growth outlooks are a bit more negative. Inflation has risen by less, and the authorities have substantial space to continue doing accommodation. But in just about every other economy, we're seeing this consolidation of both fiscal and monetary policy, with some heterogeneity, of course, in the mix of how these two instruments are being used. We have, just for illustrative purposes, in the report flagged this group of countries in Asia that has relied on more aggressive monetary tightening earlier on, and another group that has been able to keep monetary policy a bit more accommodative for longer. And the rationalization for this that we see coming through quite clearly in the data is that there's a quite close correlation still between core inflation developments, how fast core inflation has risen above central bank targets, and the stage of the economic recovery. So in countries where output gaps are still substantial, including in Indonesia, in Malaysia, and in Thailand, core inflation has been much slower to rise. It's only recently risen above central bank targets. And so those central banks have been able to delay tightening monetary policy a bit longer, though tightening is now underway in all three of those. Next slide, please. So this is a zoom into just monetary policy. On the left, you can see how policy rates have risen from their pandemic minima in this cycle. And we now have underway one of the most synchronized monetary policy tightening cycles that Asia has seen in a number of decades. Just about every country in the region, except for Japan and China, have now hiked monetary policy rates. You can see on the right that markets expect those hikes to continue into 2023, but that the size of the additional hikes that are expected by markets and by the IMF is not that large. So we expect the cycle to be relatively shallow in historical perspective. Next slide. One of the reasons that we think monetary policy is not having to respond so aggressively is that inflation expectations remain well anchored at the policy horizon, while short-term expectations at 12 months ahead have risen well above central bank targets. That's what is shown by the solid lines on the left. The dashed lines are showing you expectations about inflation in 2024. So that's the usual horizon at which monetary policymakers expect that they're able to bring inflation back to target. Those expectations have remained extremely close to central bank targets. And so there's a broad-based expectation, including from the IMF and our WEO, that inflation in Asia will quickly converge back to central bank targets from the levels we're currently seeing. That is despite the fact that on the right-hand side, nor the market nor the fund expects monetary policy rates to actually become positive until the end of 2023. So I think the way we're seeing monetary policy and the way markets seem to be seeing it is that what central banks are doing across Asia is they're withdrawing monetary accommodation, but they're not implementing tight monetary policy that's going to squeeze domestic demand. That's at least not expected in the baseline. Next. What if we're wrong though? Okay, so what if core inflation doesn't fall back to target as fast as we expect and without the need for a strong monetary tightening? We show in the report a couple of reasons why we might be worried about this. One reason is that if you estimate the drivers of core inflation across Asia using historical data, you find that core inflation tends to be quite persistent. So if core inflation is high last year, in the data, you tend to expect it to be high this year as well. And so the baseline that we currently have is one in which core inflation is not that persistent. It's risen quite sharply, but we expect it to return to target over the course of next year. So at least that wouldn't fit what has traditionally happened in the data based on the empirics. So that's one source of possible concern. And this is particularly stark among the emerging market and developing economies. The second point to note is that core inflation in Asia in the data responds quite strongly and persistently to shocks to non-core products on global markets. We show here the response of core inflation to shocks to global shipping costs, which are quite strong and persistent, particularly in the emerging markets, to shocks to global crude oil prices and commodity food prices. In all cases, core inflation responds very strongly. And I remember, core inflation doesn't actually include any of these products, right? So these are spillovers from non-core shocks into core inflation. And what this suggests is that to the extent that we get favorable developments on these global commodity markets in 2023, with food prices falling, crude oil prices falling, that could underpin the baseline of falling core inflation. But if we get less favorable developments on global commodity markets, that would be a scenario in which you would worry that core inflation could stay high for longer. And what we find, we run this through this kind of a scenario of more persistent core inflation through our models, and we find that monetary policy in Asia would have to respond to that kind of a scenario, with much tighter policy than what is currently in the baseline, and that would place an additional drag on growth. Next slide, please. Okay, one source of concern has been recent volatility in foreign exchange markets, with exchange rates depreciating quite substantially against the dollar so far this year. On the left-hand side, the green bars show you how much Asian currencies have depreciated against the dollar this year so far. Across the region, we've seen depreciations between 5 and 15% in most cases. Indonesia is on the lower end of that. The rupiah has depreciated quite a bit less than most other currencies in Asia. We see two sources of external shocks that largely explain the degree of depreciation across the region. What these scatter plots are showing you is on the vertical axis, they show you how much each currency has depreciated against the dollar this year. And on the horizontal axes, they show you two different global shocks. One is how the interest rate differential has changed between the country and the US. And on the other one, it's how the terms of trade have deteriorated or improved for each country. And you can see there's quite tight correlations, particularly with the terms of trade, where the R-squared on this scatter plot is about 0.5. So these two factors, the responses of monetary policy and developments in terms of trade, largely explain how currencies have been moving in relation to each other across Asia. Next slide, please. There's if the pressure on exchange rates, which is not expected in the baseline to continue, exchange rates are in our baseline are expected to remain relatively stable looking forward. But if we get continued pressure on Asian exchange rates, this would pose a risk to inflation. So we estimate in the data that the exchange rates have been contributing to rising inflation in Asia, but that contribution has been quite small through the second quarter of 2022. There's a risk that increases next year. One of the estimates that we provide is we estimate exchange rate pass-through coefficients that are conditional on the level of inflation in the country. And what we find is that as inflation rises, the rates of exchange rate pass-through also seem to rise. And so there's a risk that having a depreciation when inflation is at 2 or 3% maybe doesn't lead to much inflation. But if you get the depreciation when you're already at 5 or 6, then that might give you more exchange rate pass-through than we've seen in the past year. Next slide, please. Okay, what else are central banks doing? We've talked about the monetary policy rate responses. The other thing that they've been doing is allowing their reserves to run down. This is a mix of valuation effects affecting reserves, but also some FX intervention that many central banks have said that they're doing. In that context, we're seeing relatively large falls in the stock of reserves across Asian emerging markets. On average, we've seen reserves fall by about 10% so far this year. That's quite substantial. I think one of the reasons that we're still comfortable with the situation is that if you compare the level of reserves, our adequacy metrics still see reserve buffers across Asia being relatively comfortable, broadly appropriate for precautionary purposes, is the language that we use. But what we are concerned about is the rate of fall. The concern being that if reserves continue to fall at the rate that we've been seeing recently for another 6 to 12 months, that would take reserves to worryingly lower levels. And so we are calling on authorities to be judicious in their use of FX intervention. FX intervention should be part of the toolkit. It has a role to play, both to stabilize foreign exchange markets, to prevent against financial stability risks, and also to support monetary policy where there's a risk that inflation expectation is the anchor. So we see a role for FX intervention, but we think central banks need to be judicious in its application in order to keep their powder dry and make sure that they have adequate reserves in case they get hit by a really adverse shock in 2023.
Sorry, I'm reminded 2 or 3.
How many minutes?
2 or 3.
2 or 3. Okay, let me try to do that. Okay, so we've seen, this is something that we flagged before, financial vulnerabilities starting to rise in the corporate sector on the left, with liquidity and funding costs rising. And we've seen, we've been worried about in the past, and we've just put out a report about real estate markets where we flag that valuations in Asia's advanced economies have really been very high. And while those have started to back off recently with the monetary tightening, they do still pose substantial risks in some of the advanced economies. Next slide. What about fiscal policy? We've seen most countries implement fiscal consolidation following the pandemic as they've been withdrawing support. I mentioned that earlier. We think the important imperative here is that the region needs to arrest what is now a 15-year trend of rising public debt levels that was aggravated further during the COVID-19 pandemic as countries deployed exceptional support to the economies. We think that fiscal consolidation needs to proceed in the medium term with a credible framework to getting to a debt stabilizing level of the fiscal balance. Indonesia is well on track to doing that, and we strongly support the authorities' commitment to restoring the 3% deficit ceiling next year. We think that's very important. Next slide, please. One risk that we flag is that if interest rates stay very high, fiscal consolidation will need to go even farther in order to stabilize public debt levels as debt dynamics become less favorable. Next slide. But of course, in the interim, that's kind of the medium-term orientation of fiscal policy. In the short term, we've had economies affected by extremely adverse food and energy price shocks. These disproportionately affect the vulnerable households in the region. And so there is, of course, a very strong imperative that we fully support for governments to support those vulnerable households in the face of these shocks. Most governments are doing that or have tried to do that across Asia. One of the concerns that are flagged in this report is that we're worried that there's scope to make these measures more targeted towards the vulnerable households. If these measures are untargeted, then they really are running into a lack of fiscal space in a lot of the economies in the region. And so we think to preserve fiscal space, we need to make sure that this support is as targeted as possible to the people who need it, and is that the measures are designed in a way so as to be temporary, that they can be withdrawn once the shocks pass. Next slide. For the long term, two concerns. During the pandemic, Asia saw among the longest school closures of any region, particularly in the low-income economies. We worry that if this is not corrected with compensatory policies in the years to come, we're going to have a generation with depleted human capital. and that could affect long-term growth in the long term. And another concern that's flagged is that fertility rates tend to fall substantially and persistently after pandemic episodes. If these two factors are taken together, this would have a substantial long-term impact on the human capital stock for Asia and on the supply of labor in the long term. So these are things that are flagged in the report. Next slide. And this is just a summary slide. I've spoken extensively about fiscal and monetary policy. Let me just mention that our concern about scarring is also motivating a real call for governments to be ambitious about their structural reform agendas. We think there's substantial scope to support long-term growth through productivity enhancing reforms. And in Indonesia, we're quite satisfied and encouraged by the government's commitment to pushing those agendas ahead, because we think that's the amount of scarring that we're seeing in the baseline at the moment is worrying, and policies need to be taken to try to unwind it. Thanks very much.
Thank you, Mr. Yan. It's very interesting, yeah, about the headwind, yeah, and how it's affecting the profile of Asia economic growth, yeah, of how we decline from the baseline, and then tighter monetary condition, and then yeah, interest rate, yeah, tighter interest rate, and then you also mentioned exchange rate pressures, yeah, that we should be careful about the international drivers, and emerging markets like in Asia should be also care about the flexible exchange rate, yeah, but how maybe there will be like a new equilibrium of yeah, not only Indonesia, Rupiah, yeah, but also some of exchange rate in emerging countries. Thank you, very nice. And also you mentioned about the impact of global shipping costs to the core inflation. I think it's very interesting to discuss, yeah, about how shipping costs also will affecting the core inflation. Yeah, core inflation will be affecting the interest rate, and interest rate also would have affecting to domestic macroeconomy. Thank you for that. And next, we move to Mr. James. Yeah, Mr. James Walls, or you call Mr. Jim. Yeah, Mr. Jim has been in Indonesia around 1.5 years, right? 1.5. Okay, so Mr. James, I think it's also good in Indonesia for selamat pagi, selamat siang, or yeah. Usually has been familiar with Indonesia, yeah. And okay, I will read about the Mr. James CV, yeah. Before Mr. James in monetary and capital department, yeah. Before in Indonesia office, Mr. Wolf was an advisor in the monetary and capital market department, and has coordinating the department of surveillance, program monitoring, and technical assistance works in the Western Hemisphere. He has led financial sector stability assessment for Azerbaijan and Algeria, and was deputy chief for China. Yeah, I think you also mentioned in your PowerPoint about the impact of China's slowdown to Indonesia will be greater, because the correlation between Indonesian economy with China become more and more closer. Yeah. And he has also led technical assistance missions on developing monetary policy frameworks and implementing macroprudential policy, and coordinated surveillance works in Asia and Latin America before his current assignment. And before moving to monetary capital market department, his responsibility included surveillance and analytical work in emerging markets, most recently in China and India. His analytical work has covered financial regulatory reform, macro financial risk, and he was co-editor of a book on Asian financial system. He also worked in the IMF policy design department, assessing the IMF surveillance of developing economies. So there are many experience of Mr. James, yeah, so we can learn many things from him too. And he has a PhD economics from the University of Chicago and BA in economics from the University of Pennsylvania. Okay, please, the time is yours. The same to 25 minutes or 30 minutes.
Terima kasih, selamat pagi. Saya mulai 2 tahun lalu sebagai perwakilan IMF di sini di Jakarta, tetapi meskipun saya belajar bahasa Indonesia belum bisa berpresentasi di dalam bahasa Indonesia. Jadi saya akan terus dalam bahasa Inggris jika tidak apa-apa. I have a presentation too that can be brought up. Maybe while we're bringing up my presentation, normally I would explain a little bit about the IMF at the beginning of my presentation. So I'll just say the IMF was founded back in 1944 at the end of World War II. And the idea of the institution originally was to try to encourage more cooperation in economic policies among the countries of the world to try to stabilize the global economy after World War II. Since then, the global economy has changed a lot. More countries have flexible exchange rates now than did in 1945. Capital flows have become much more important. So the fund has had to evolve with the times and try to remain relevant over the course of the 70 years that it's been in progress. Indonesia became a member, I believe, in 1954, and this office opened in 1964, my office. I'm the 21st representative in Jakarta of the IMF. So I've done a lot of things at the IMF, but this is the first one where I don't have to wear a suit all the time. So I'm very happy to wear batik instead of a suit. And the fund does three main things with member countries. We do surveillance, where we talk about economic policies. Some of these policies are multilateral, like what Jan was talking about across Asia and the world. Some are bilateral, where we do a report every year on the Indonesian economy. The last report was published in March of this year. We also do technical assistance, where we help countries better implement economic policies. So right now we're talking about stress testing with the central bank and the OJK. We also talk with the finance ministry about how to think about linkages to state-owned enterprise, that kind of thing. And then the IMF also does lending to countries that have balance of payments difficulties. Currently, there's no lending in Indonesia. So those are the three main things we do. And it's my job here to try to coordinate Indonesia and how Indonesia works with the IMF. And it's something I've enjoyed very much so far. So I'll be talking about how the global economic outlook has been evolving. But since Jan has covered most of that, I will focus much more on Indonesia. So next slide, please. So I'll talk very quickly first about some of the main issues in the global economy and how the IMF's views on the global economy have changed this year. And then I'll talk about where Indonesia stands and how we feel about the prospects for the Indonesian economy. So next, please. So Jan mentioned how difficult the global economic outlook has become this year. The IMF, we revise our economic forecasts every few months. This year, we've revised downward every time. So Jan mentioned how much more difficult the economic outlook is now around the world. We've revised our growth forecasts down for most of the world's large economies over the course of the year. Indonesia has actually done pretty well so far, at least according to that measure. We haven't really changed our forecast that much over the course of the year. So I'll talk a little bit more about how so far Indonesia has been more insulated from the global economy than many other places have been around the world. Next, please. So there are three main things that have led us to reduce our forecasts around the world. As Jan mentioned, the first one is weaker global demand. I think this is sort of a very unusual experience that we have right now in the global economy. It has happened before where the major economies of the world are all slowing down or performing poorly at the same time. But unusually right now, we have three very different situations that are leading to this. So in the US, the main reason for the slowdown is very tight monetary policy it's being necessitated by high inflation. In Europe, there's also high inflation, but that has been aggravated by the war in Ukraine and the dependency of many European countries on fuel exports from Russia. And then in China, there was already a lot of concern about instability in the financial system before COVID. And now COVID has reduced consumer confidence because of uncertainty about how to manage the zero COVID policy and how help the economy grow at the same time. So we have three very different factors across the world's three largest economies, all of which are weighing on global growth. So that's a highly unusual situation. The second factor around the world is this persistent inflation that's most visible in the US and Europe, but it's quite an issue in many countries. Asia has been a little bit insulated so far from that. Japan and China in particular, inflation has been quite low, but in Indonesia, we are seeing high inflation here, especially in the last month. And then the third risk factor that has really opened up this year are tighter financial conditions that have been brought about by central banks trying to bring down inflation in their own markets. So the combination of these three factors, high inflation, weaker demand, and tighter global financial conditions have really weighed on economies around the world. Next, please. And unfortunately, things can always get worse. So the fund is concerned about a number of risks around the world and the possibility that the outlook that we have already could become worse. So the first thing we're concerned about is how central banks and governments coordinate their economic policies over the course of the year. So what we hope for, and what has been happening in Indonesia, is a coordination of monetary and fiscal policies to try to support stable growth. So I'll talk about that in the Indonesian context, but the concern would be, for example, that central banks tighten monetary policy very much, but that leads to a lot of unrest in many countries where high interest rates and slow growth lead to social concerns, and then governments will spend more money to address those social concerns, but that undermines the central bank's policies on inflation. So these potential conflicts among economic policies are a real concern, as is the possibility that central banks could tighten too much and throw economies into very severe recessions. The second concern we have is deteriorating global financial conditions. So high interest rates are already a risk around the world, but there's always a possibility, as we saw in Britain a few weeks ago, that there could be a problem in the global financial system that we don't see now, but because of the difficulties that we have and high interest rates, some underlying problem could suddenly become more visible. So these high interest rates are already a concern, but it could become, we may see even more dislocations coming from just difficulties making markets work, or regulations that we have in the global financial system that are intended to support stability, but now are leading to more problems. The third concern is that inflation could be very persistent. We don't really know how to bring down, we've dealt with high periods of inflation in the past, but this is the first time in a long time that advanced economies have dealt with such high inflation. So while we know that eventually inflation will respond to monetary policy, we haven't dealt with this in a long time. We're not really sure how things have changed. So it's possible that inflation could remain quite persistent for a long time, and that's a real risk. And then finally, the war in Ukraine could continue. There's no obvious end to the war at this time. We're not sure what a settlement would look like, so that's a fourth concern. So it's quite a dark outlook already, and there's a possibility that things could become even worse for a number of reasons. So next, please. So now I'll talk a little bit about how Indonesia fits into this outlook. Next. So the first thing that I would talk about is Indonesia's trade linkages to the rest of the world. So Indonesia's largest trading partner is China, and about a quarter of Indonesia's trade exports go to China. The second largest country that Indonesia exports to is the United States. About an eighth of Indonesia's exports go to the US. And in between those is ASEAN, the other Southeast Asian countries. So quite a lot of the exports that Indonesia sends to other ASEAN countries are goods that are then sent on farther to China or to the US. So really the two major export markets for Indonesia's goods, or at least the two biggest, are China and the US. So when we see the Chinese economy slowing down, especially consumer demand in China because of COVID, we're quite concerned about demand for Indonesian exports. And it's similar with the US, that with inflation very high in the US and the potential for a recession there, we're also concerned about consumer growth in the US and demand for Indonesian exports. So far, Indonesia's exports have held up pretty well. I'll talk about that a little bit more, but this is a big concern we have at the moment. Next, please. And just to explain why this is such a concern, it's at the beginning of the pandemic, the Chinese economy was the first major economy to recover. China's zero COVID strategy worked very quickly back in early mid-2020, and the Chinese economy managed to return to growth and reopen before any other large economy did. The US opened about 6 months later, as vaccine progress was very quick in the beginning of 2021, and American demand returned. So here in Indonesia, throughout late 2020 and 2021, we were more affected by COVID in a sense than the Chinese or the Americans were, because we hadn't yet been able to reopen as much. But because these economies were growing much more strongly, they were able to absorb a lot of Indonesian exports, and that really supported growth. So one thing that was very clear, especially in the second half of last year, was that Indonesian exports of manufactured goods, not just primary goods, but even manufactured goods, held up very well and were really supporting the economy. And the economy was able to keep a lot of factories open last year, because of good measures on health and sanitation that allowed Indonesia's exports to remain strong. The problem is now the Chinese and the US are, in a sense, paying for their successful policies. So China's zero COVID policy was very effective in the early phases of the pandemic, but now that the virus has become more contagious, it's much harder to control. And that has led to more lockdowns and more uncertainty in China. In the US, the vast fiscal stimulus that the United States government pushed through last year has now led to higher inflation because there was the government overestimated how much they could spend without leading to much higher wage pressures. So this American stimulus helped Indonesia's exports last year, but now high inflation is one of the consequences of that stimulus, and that's more of a problem. So now Indonesia's economy is recovering, and we see a lot of good news on the Indonesian economy, but unfortunately, the Chinese economy is slowing and the American economy is slowing, so that export engine is going to be weakening over time. Next, please. So what I mentioned that exports were quite strong last year, part of that led to a real improvement in the balance of payments and a big increase in international reserves that the Indonesian central bank can use to try to support the currency when there's volatility or when there's concern about stability. So part of this strength in reserves, you can see the red line on the right, reserves went up quite a lot during the course of the acute phase of the pandemic. That was partly because exports were strong, and partly because while the Indonesian economy was weak, we were importing less goods and services here. And because of that, the overall trade balance was strong, which led to this big accumulation of reserves. Since the Indonesian economy has recovered, now more capital goods and more consumer goods are being imported. So the trade balance has weakened a little bit, but the reserves position is still pretty strong, though as Jan said, it has deteriorated in the last few months. So we are a little bit concerned that if this deterioration continues, it is reducing in a sense, the ammunition that the central bank has to deal with potential volatility. But so far, the position is okay. It's just a concern for the future. So next, please. Just to talk a little bit about how financial markets are supportive. There have been capital outflows from Indonesia, as there have been in a lot of other countries over the course of the pandemic. But two things that I would point out about this are that in other periods when there has been a big dislocation in the global economy, Indonesian interest rates have risen by a lot. That happened in the taper tantrum in 2013 and the global financial crisis in 2008. That hasn't happened as much this time. Part of that is because the central bank has bought a lot of government bonds over the course of the crisis, but part of it is also because Indonesia's economic management has really been quite strong over the last 10 years. So investors have been much less nervous about the Indonesian economy. The second thing I would point out, which is also a consequence of this greater credibility, is that Indonesia's exchange rate was relatively stable throughout the pandemic. When I moved here, I was checking the exchange rate every day for a few months, but then I stopped because it was the same thing. It was 14,450 every day for about 6 months. So there was no reason to check the exchange rate. But if I had lived in South Africa or Brazil or Canada or Japan, the exchange rate changed quite a lot. So this has changed a little bit in the last few months. There has been more depreciation. But Indonesia's exchange rate was quite stable throughout 2021 and early 2022. And that also shows the confidence that investors had in the economy here. So next, please. So as I said, there have been some portfolio outflows from Indonesia, which means that a lot of foreign investors have sold their holdings of government bonds. So far, that hasn't had a big impact on interest rates because the central bank has stepped in to buy the bonds instead. But there is a concern that as the Fed continues to raise interest rates in the US, that makes American debt more attractive relative to Indonesian debt. So the policy rate increases here that the BI has pushed through over the last few months, those do make Indonesian assets a little more attractive. But the yellow line on the right here is the spread between Indonesian bond yields and American bond yields. And that has really fallen in the last few months. And that's one of the reasons why there have been foreign investors selling Indonesian debt, and that's one of the reasons why the rupiah has weakened by about 10% over the last few months. Next, please. So as I said before, the exchange rate was very stable for a long time, but now we have seen some depreciation. And in addition to the rupiah weakening by about 10% over the last few months, we can also see that financial markets are a little less confident that the rupiah will stay stable over the long run. There's more concern that it will either probably continue to depreciate. And the way we can see that is that more and more banks and companies are buying financial contracts like swaps and forwards that allow them to insure themselves against potential depreciation of the rupiah. So the rupiah has weakened by a little bit, and financial markets clearly expect there to be a little bit more depreciation in the future. And participants in the market are worried about potential volatility, so they're now buying insurance against it. So we can see that what I would think of as a normal functioning of the market, where there is some volatility and companies insure themselves against that volatility, that has now returned. So next, please. So as I said a few slides back, the Indonesian economy has recovered, and we do see a lot, begun to recover, and we do see a lot of good news on the domestic front. So while the news outside is not so great, it does look so far like the Indonesian economy has recovered in a pretty stable and sustainable way. So on the left, you can see that bank lending has really grown. Bank lending had been slowing in Indonesia for a few years, even before the pandemic. And then obviously during the pandemic, it fell quite dramatically. But there was a recovery that began in the middle of last year. And now we see that lending is growing at about 10% a year. The central bank thinks it could grow by 11% next year. That's a pretty healthy rate of growth for the financial system. It's high enough to support investment, but not so high that we would be worried that banks are making a lot of bad loans. So this is a pretty good growth rate. And the overall capital position of the banks, which is their ability to absorb losses, that has also remained quite strong throughout the pandemic. And again, this is another indication of how good Indonesia's macroeconomic management has been over the course of the past few years. And then on the right, this is the indicators that we look at to see investment in the Indonesian economy, which is an indicator of how growth might rise in the longer run. So here too, there was a lot of weakness during the pandemic, but now we see that the indicators of investment seem to be growing at about 5 or 6% a year. Again, this isn't a huge boom, but that probably means it's a more sustainable rate of growth. So we would hope that this can continue to support pretty strong growth for Indonesia in the medium term. Next, please. So again, while the domestic news has been pretty good, Indonesia is not, it's literally an island, but not metaphorically an island. So we do see inflation here that comes in from the rest of the world. So we can see that food prices have gone up a lot. Everybody here was aware of what happened with palm oil earlier in the year, that we saw very high prices for palm oil and a lot of volatility. Also, this has really affected wheat around the world, which is less important in Indonesia, but it affects the price of feed for chickens and for cows, and that has also affected the price of food in Indonesia. So there has been that higher inflation around the world has fed through into the Indonesian economy, originally through food and palm oil, but now also through fuel after the decision by the government to raise fuel prices by 30%, which I'll talk about in a little bit. But that has pushed overall inflation to a higher level than it had been before. We would expect that the inflation rate will come down a little bit just because of this one-off increase in fuel prices. That won't be sustained. So we wouldn't expect this very high level of inflation to be held on for very long. But the central bank is being vigilant about looking at this high level of inflation. It is a concern that even though it's imported, they do need to address it. So I'll talk about that in a minute. Next, please. I'll talk about it now. So the concern that the central bank has here is that when inflation comes from foreign prices and from global commodity developments, it's not very easy for central banks to deal with. So they can raise their policy rates, but the policy rate works by making it more expensive for people to borrow money or for companies to invest. And when you do that, it slows down the domestic economy. But the Indonesian economy still has plenty of capacity and plenty of room to grow before we see inflation. So this isn't an optimal thing to do because the inflation isn't coming from a domestic factor. So what we would normally suggest that countries do in a case like this is allow the exchange rate to depreciate. When inflation is coming from abroad, you want to encourage people to buy more domestically produced goods and services and fewer things from abroad. But in this case, the problem is that exactly those goods that are expensive from abroad are things like food and fuel that people demand the same quantity of almost regardless of how expensive they are. So that's a real issue. So this has put the central bank in a difficult position. So what they have done is to try to maintain stability by looking forward at where inflation is going to go and thinking about how the exchange rate will evolve. And that has led them to make these 3 policy rate increases over the last few months. but this is a difficult position and there aren't a lot of great options. So next, please. Another area where, again, Indonesia's credibility has been quite strong over the last few years is on fiscal policy. We expect the government to get back below its 3% of GDP budget ceiling next year. The budget that's currently being debated, or I guess it's now been approved by Parliament, would be below 3%. And we think that that'll be a relatively easy target to achieve. This is quite an achievement and something that I think is not necessarily getting the attention that it deserves. There are very few large countries around the world that have credible plans to return to a pre-COVID level of fiscal sustainability. So Indonesia has done this, but or will very likely finish this next year. But most other large countries still have major fiscal consolidation ahead of them. And tax revenue remains relatively weak, or they're still spending large amounts of money on temporary programs. And moving back to a more sustainable fiscal position is quite difficult. But in Indonesia, this has been done quite successfully. And it's really something that I think the finance ministry and the government here deserve a lot of credit for. Next, please. As I said before, one of the reasons why Indonesia's exchange rate and interest rates have been so stable is because the central bank has been buying government bonds. So this is something that a lot of central banks have been doing around the world, starting with Japan 20 years ago, and then other places like the European Central Bank and the Fed have done this as well, the Bank of England. We don't really know how much of an effect this will have on inflation. In the long run, we tend to think that large amounts of government bonds purchased by central banks undermine the ability of central banks to implement monetary policy and control inflation. That's certainly the lesson that we've seen in many emerging markets over the last 40 years. But it seemed like these rules could be bent a little bit for the advanced economies over the last 10 years. And so far in Indonesia, while the central bank has bought a lot of bonds, we haven't seen a lot of pressure on inflation. But we know that if this continues forever, it will eventually lead to pressures. That has always been the case in the past. So it's good that these were done on an emergency basis over the last few years, but the central bank and the Ministry of Finance have agreed to end those purchases by the end of the year. That's a cautious and prudent policy, and we think it's a good idea. As I said before, exchange rate flexibility can help by rebalancing goods, but it does present this difficult trade-off where if people are buying food and fuel from abroad, those things become more expensive as the exchange rate depreciates. So again, another policy that Indonesia has been good at implementing throughout the COVID-19 crisis and also right before the fuel price increase is trying to support low-income households through transfers. So about a week before the decision was made to increase fuel prices, for example, Minister Sri Mulyani and Governor Perry went on TV to talk about how an additional, I think, 25 trillion rupiah were going to be spent to support households during the period of higher fuel prices. That's a very good policy to try to make sure that low-income and vulnerable households are not hurt by these economic policies. And that's, again, something that Indonesia proved very good at doing during the financial crisis. So next, please. How much time do I have?
2 minutes.
2 minutes. I can't see how many slides I have here. I'll just talk quickly about 3 kinds of reforms that we think would strengthen the Indonesian economy in the long run. One is that Indonesia raises much less tax revenue than most other countries at this income level do. So nobody likes to pay taxes. People don't like paying taxes, even in France and Denmark, where they pay half their incomes in them. So in Indonesia, it would be good to think in the long run about how to raise more tax revenue. It's not an easy thing to do, but it's important for achieving development and growth needs. Next. And then on the other side of the fiscal equation is spending. Indonesia's fuel subsidies were very effective in cushioning the economy through these higher fuel prices, but they're very expensive. And it's cheaper to just support low-income households. And then the money that you save from supporting higher income households can be spent on infrastructure or health or education. So that's a better allocation of resources and would also allow more investment in long-run growth. And then next, please. The second thing is how to support industrialization and exports and economic growth in the long run. There's a lot of downstreaming policies in Indonesia. The history of how to support how government targeting for particular industries works is mostly failures around the world. It's very hard to make these policies work successfully. But one thing that tends to work is to try to focus on the strengths that a country already has. So in Indonesia's case, manufactured exports have performed very well over the last few years, and focusing on why those exports have been successful and continuing to support those kind of exports through targeted infrastructure and making it easier for those companies to expand and hire more people. That would probably be the best way to increase productivity over the long run. And then number 3 is climate change. As I saved the most depressing topic for the end, even more depressing than war. It's in climate. The issue with climate change is that all countries of the world effectively now, including Indonesia, have promised to implement policies that are consistent with only a 2-degree temperature rise around the world by the end of the century. But nobody has any medium-term plans to achieve to get onto this path. So the next slide, please. The main way to get onto this path would be to raise the price of fossil fuels above market levels, to try to encourage more and to try to reflect that these fossil fuels do damage to the economy or to the environment, well, and the economy. And also that would increase investment in renewable energy. In Indonesia's case, renewable energy would largely come from, at least in Java and Sumatra, could come from geothermal, which is a real strength for this economy. It's very difficult to build an entire electrical grid around solar and wind, but geothermal is easier. It's stable, it's on all the time. Iceland has an entirely geothermal grid and it works very well. So Indonesia has a huge amount of capacity in geothermal. The question is, how do we structure the electric industry for buying and supplying electricity in a way that incentivizes more investment in geothermal and also solar and wind? But part of that will have to be raising the prices of things like coal and diesel and gasoline above current levels, but especially coal. But that will pay a lot of dividends in the long run in terms of not only climate change, but also public health. You can see in many countries that have reduced the use of coal over time, public health indicators tend to improve very quickly. So in the US and in Europe, when coal was phased out in favor of natural gas and nuclear, the number of kids who had asthma tended to fall, respiratory diseases fall, heart diseases fall. I mean, there's a huge improvement in health in addition to the environment, but environmental damage over the long run is quite severe, and moving toward renewables and geothermal is an important step. And I don't mean to underestimate how difficult it is. It will be quite challenging here as it is everywhere, but it's important. So I think I'm maybe a minute over, but.
Okay, thank you. Please give the applause to Mr. James. Okay, if I'm not here, yeah, there are 3 important messages from Mr. James' presentation. The first, that geopolitical matters, and the condition of China, we should be careful because China has a big correlation, with a high correlation with Indonesian economy, and because we know that Indonesian export also major going to China, and there are also some evidence in Indonesia, Pak James, about for example, you mentioned about West Java, I know that in West Java, for example, there are a big textile industry, for example, it's called PT Kahatex, it's has they did the layoff, in the last month, and about maybe 5,000 workers, and why, when I asked to the workers, the information, why the company layoffs, it's because of the demand for the export from China and Japan is declining. They have declining orders, and then the container also becomes the problems, about the shipping and container, and like so. When you mentioned the second point about the structural reforms, it's very important for us, because as we know, we cannot be depend also on the global market only, we should do also the structural reformation in Indonesia. You mentioned about industrialization, and also maybe to strengthen our domestic industry, for example. And the third policy choices, you also mentioned about the flexible exchange rate. And you mentioned also about that monetary policy, fiscal policy, it did not have many choices. Not only have the large space, it's small spaces currently, and maybe structural reform, especially also in the green economy and renewable energy is also the futures of the driver of Indonesian economic growth. If I'm not wrong. Okay, maybe we can discuss it in terms of running of time. Okay, thank you. We will open the session question and answers. For the first round, I give the 3 questions to the floor and 1 question to the Zoom online. Yes. Okay. For the first, maybe I invite Professor Muhammad Ihsan as my teacher and senior. And then the second one, who will First, Professor Muhammad Ihsan. The second one who will, please raise your hand. Raise hand first, yeah, and then I will give also the opportunity. From the student, please, or from the Pak Chaikal or Arif. Okay, Pak Ican, please.
Okay, thank you, Kalista. I have three. Can I have three questions?
Yes, of course.
Okay.
For sure.
One is the first one is related to global inflation. Whether could be both of you, or James and Jan. Do you think this is the global inflation would be temporary or permanent? Because I read the Project Syndicate article from Professor Mike Spence about secular inflation. If you look at from the history, if you look at over the past decade, the globalization has decreased our inflation because of China, role of the China, because they provide a cheap manufacturing product for the world. If you look at for the futures, I think the trend of globalization will reverse because of the trade war and etc. And then the second one is if you look at the demographic transition, especially from China, if number of fertility has declined and then make the labor supply in China declining, and if you look at their real wage has doubled over the last 10 years. That's the second one. The third one is on the climate change. The climate change is also raise the inflation rate because of the uncertainties about the weather, and it would trigger the inflation across the world. I also understand about the upside of inflation rates because of technology, especially on the digitalization will reduce cost of transaction. What do you think about the global inflation, whether it's temporary or permanent? The second one is about I think I skipped the second question because you already answered. The second one is about what do you think about the industrial policy? Because if you look at all countries, like even in US, they now adopt the industrial policy, so or the encouraging the industrialization. Thank you.
Thank you. First, Mr. Yan, please.
Sure. Maybe I can start on the first question. So we expect global inflation to remain high for the indefinite. I mean, you talk about permanent global inflation, right? So I think a first thing to say is that the fund and of course the US authorities and just about everyone else, not everyone else, but just about everyone else through 2020 and 2021 expected the increase in US inflation to be transitory, right? And monetary policy advice was oriented around that assumption. I think there was some good reason for thinking that that could be the case. We saw a lot of proximate causes to the rise in inflation in 2021 that looked like they would be transitory. Supply disruptions related to the pandemic around the world that we thought would be resolved quite quickly. I think in the data, I put up the chart on how our forecast path for US inflation has been revised up in each successive WEO in the last 2 years, has proven that those assumptions turned out to be wrong and overly optimistic about how transitory inflation would be. So I think we're in a context where inflation is going to be higher for longer. The question is for how long. But we've now seen monetary policy start to respond very forcefully in the US and in Europe. I think we're still seeing inflation surprising on the upside. So as Jim mentioned, central banks and advanced economies haven't had the task of bringing down high inflation in a very long time. There's a lot we don't know about what that process will look like. But I think our policy advice, and I think what the messages we're now seeing from the Fed and markets are pricing in, is that the Fed is going to stick to this task until inflation starts to decisively fall in the US. And so we're confident that in the baseline, inflation will fall and will turn out to be not permanent.
Between the long run inflation, before the further in 70, the inflation over inflation is about 5%, right? And then down to 1 to 2% over the quite long term. But now my assessment, the inflation rate would be higher than 1 to 2%. It's moving to around 3 to 5%. What do you think about that?
I mean, the Fed has an inflation target of 2%, right? So, I mean, yeah, there's a question, is that the right inflation target given different structural factors? I don't think we've, our past chief economist, Olivier Blanchard, has, put that on the table 10 years ago as maybe this needs to be revisited. I think there are pretty serious costs and benefits to revisiting inflation targets. There's never really a good time to do it, particularly now where inflation is very high. I think the Fed's main priority right now, rightly, is in ensuring that it doesn't lose credibility in achieving its inflation target. And so I wouldn't expect that discussion to really be prominently discussed or entertained in the US anytime soon. But I agree with you that the structural factors that have been keeping inflation low for a long time seem to have changed. And that could change the equation for central banks. But I think that's just a discussion we will have to open later once we've taken care of this more transitory problem that we're dealing with at the moment, which I should add is intimately related to demand policies, excess demand in the advanced economies at this stage. But that's also a factor that it should be transitory and monetary policy should be able to handle.
Thank you. Yes, Mr. Jeff, if you want to add something. Or maybe industrial policy? Yeah, but you can
well, on inflation, I think it's what Jan said is exactly right, that I think the Fed will continue to raise rates until they see inflation falling significantly in the US. I do wonder how much political support there will be for bringing inflation down in the US from, say, 4% back to the target. I think 8 to 4 is easy to sustain politically, but if it requires a long recession for the US to go from 4 to 2%, I think it will become much harder for the Fed to do that without getting a lot of criticism from the government. And this is why it's important for central banks to be independent and be able to continue to engage in their policies without too much interference from central banks. But it wouldn't surprise me if inflation proves persistent in the US, there will be a lot of pressure from the government in the US to raise the inflation target. And like Jan said, there are costs and benefits. There's a cost to having higher inflation over the long run, and there's a cost to the central bank reevaluating its target. But I think it will, if it takes a long time to get inflation down to the Fed's target, I think it will be politically more and more difficult for them to sustain it. But that's not a forecast about long-run inflation. That's just my general sense of despair about U.S. economic management. And then on industrial policy, you say that the U.S. is doing it. That's true, but the U.S. also has privately funded health insurance system and ridiculous gun laws. So not everything that the U.S. does is a great idea for other countries to copy, I think. Industrial policy in the U.S. has done it a lot. It's usually a total failure. So in the 80s, the Reagan administration tried to push through voluntary export restrictions on Japanese car imports. They worked for about 2 years, and then everybody bought Japanese cars anyway. So it's very hard to use trade restrictions to try to strengthen the economy, and it usually just winds up making taxpayers pay more money for things, and then and by wasting a lot of money, or at least that's the general American history. The Biden administration is trying to do this in a way that develops markets and is trying to encourage more exports of chips and other things, but they started doing that by putting effectively trade restrictions on South Korean exports, which, if the whole point of this is some kind of geopolitical goal to keep chips out of China, putting restrictions on chips coming from South Korea, which is a treaty ally of the US, it's hard to see how that's a great way to strengthen this geopolitical alliance. So it feeds into the fragmentation that is going on around the world. And it's not obvious to me that these American industrial policies are going to be very successful either. and they are very expensive. It's astonishing how expensive these policies are. I mean, so they're over the long run, but still, Democrats, well, it's a political discussion rather than an economic one. So in Indonesia, there are some things. The government very rightly talks about how nickel exports are much stronger than they were because of policies aimed at trade restrictions. Some of these policies do work. You have to look at how much of the value added by these industrial policies is staying in the country. So if companies are taking all of the export revenue that Indonesia gets from nickel and sending it back to their headquarters, it's not, if the money isn't staying in Indonesia, that's a concern. And that often has led to a lot of problems in other countries when these kinds of policies are done. But I don't know what these numbers are in Indonesia, but it's important if you're going to try to encourage industry to develop in the long run to make sure that the value added is staying in the country and design policies in a way that keep things in the country and build on the strengths that the country already has.
Okay, thank you for great answer. Maybe and thank you also for the question, Prof. Ichan. Okay, from the students, please one question. You also can ask in Indonesia. It's okay, fine. I will translate it. If you want to ask in Indonesian.
Ya, terlalu cepat.
Yeah. Or from the online, please. Tolong di. Okay. The question. Okay. I would like to ask about the recession in point of view on labor and human resource economy. One example, oh sorry, this is from Ade Raja Ardian, economic student from the Faculty of Economic and Business. I would like to ask about recession in point of view on labor and human resource economy. One example of the Great Recession that occurred in Indonesia was inflation in 1998 and 2008 and 2020. The inflation rate that occurs affects the workforce in Indonesia. For example, in 2020, there will be COVID-19. Long question. As a result of the spread of the virus, many layoffs of the workers. Yeah. Will the recession in 2023 in Indonesia experience the same thing? It is not enough to reduce inflation in Indonesia if we will concern at the monetary perspective. Thank you for the, how does the Indonesian government maintain the Indonesian economy? So there is no increase in the unemployment. Thank you. Mr. Yan, do you have some comment on the Indonesian 2020?
I mean, I think Jim and we both touched on this in our presentations, that the recovery in Asia following the pandemic is still incomplete. Output gaps are still substantial across the region. And that's one of the reasons that we think the responsive monetary policy to the high inflation this time is going to be a relatively shallow cycle that's mostly about withdrawing stimulus more than about contracting. So I don't think across the region, we don't really see monetary policy leading to higher unemployment, for instance. That doesn't seem to be what authorities are looking to do, and it doesn't seem to be, it's not what we're recommending countries do either. It's more about withdrawing stimulus as the economy recovers. The other thing I would add is that this is an extremely uncertain and volatile global economy. We have debt levels, both public and private, that have risen very substantially around the world. A large number of countries, both in Asia and in other regions, are at or very close to debt distress. Not the case in Indonesia, of course, but I think this is an environment where things are going to go wrong in the global economy. There's going to be shocks. There's going to be sources of volatility. And so in that context, what we really need to be focused on is maintaining stability and avoiding a crisis situation from affecting the domestic economy. Because as we know, economic crises, that's the worst thing you can do for a labor market or for a domestic economy. So that's something that we need to really be focused on avoiding.
Okay. Thank you. I hope from Ade, it's clear about the answers. And maybe the last question, because we are running out of the time. Yeah, there are some questions, but maybe I will recap to be one question. The first is about you mentioned that from Azharuddin Amin, Islamic University of Riau, you mentioned that the decline in the exchange rate caused the import of goods to decrease and be shifted to domestic production. Is production technology available domestically? I think it should be answered by us, but maybe from you, is there any? Do you think that you can answer this one? Production of you mean that import of goods decreased because of exchange rate depreciations and be shifted to domestic production. Is production technology available domestically?
It won't always be available domestically, but what exchange rate shifts do is encourage people to rebalance all of their spending away from foreign goods and toward domestic goods or domestic goods and services. So if, for example, cell phones become more expensive, people might spend more money on seeing movies or ordering food. And we could, that happens in a lot of countries around the world. It's not just that you shift it. It's not just that you shift from one good that's made domestically away from a good that's made abroad. So for example, tissues or glasses, those can be made in Indonesia or in other countries. Yes, people will shift toward those goods, but they will also shift toward domestically produced services and away from imported goods. That happens quite a lot in countries that have exchange rates that fluctuate a lot. But over the long run, if there's a good business environment in Indonesia, and as the infrastructure is improved, and as the export and manufacturing industries get stronger, then more things will be produced here. And these shifts in the exchange rate will also result in more goods being produced domestically. But that doesn't mean that it's a good idea to weaken the exchange rate intentionally to support those industries. That tends not to work very well. But if the industries are already there, yes, people will buy more from them if they're producing domestically.
Okay, thank you. Yeah, maybe because of the time, maybe there will be some last comment from you, Mr. Yan, about overall, like some final notes for topic today.
Yeah, I mean, I think the main message that we're trying to provide with this report for Asia and Pacific is that the global economy is looking extremely complex and volatile. I think, for instance, the example that we saw, the market reaction to the UK government's decision to loosen fiscal policy just a month ago was met with a lot of volatility. I think this is a global environment where policy missteps can be very costly, no matter which economy is being considered. I think this applies to everyone. It's a time for prudent policies to be made. It's a time for keeping our buffers strong so that we can remain, stable and growing at a healthy rate in 2023. Thanks very much for your questions.
Thank you. Please give the applause for the two speakers. Yeah, I as moderator say really thanks and appreciate for Mr. Yan and Mr. James' presentation, and for all the participants, including in Zoom and also in this room. Thank you very much also to PPIA for the hosting. And for the final notes from me, that we hope that during the economic outlook like this, we can share each other between IMF and our campus. Yeah, it's I think a good for us. Yeah, also for the student, for the lecturer, yeah, to update what happens, and yeah, maybe to make us to drive us to do the research more, yeah, and to update, yeah, the current issue, and also like the policy recommendation, how we Indonesia also can survive in these turbulent times. Thank you very much. Thank you for all, and I give the time again to the ceremony. Thank you.
Thank you very much, Mrs. Telisa, and for all the speakers today, Mr. James and also Mr. Yan, for giving such informative and interesting presentation. Please stay at your seat because, ladies and gentlemen, before we close the international lecture series, we would like to hear the closing remarks that will be delivered by the representative from PPIC to Professor Abdul Mongit. Time is yours.
Okay, thank you very much. Thank you, Jim and Jan. It's very interesting lecture and your presentation on the current development of the global economy is make us worried. Yeah, but the Jim presentation on the Indonesian economy is make me quite bit relief, yeah, about the next situation from the economy. And we note from your of your presentation the world is now facing four problems. That is because we are not yet fully recovered from the crisis due to COVID. And the second is devastating impact of the Ukraine-Russia war, especially on the food price and fuel price. And then the third problem is on the impact of the what we call it in here. We call it the brutal Federal Reserve policy. Because they increase interest rate very high and very at the very high speed, yeah, very speed. And then of course the global demand and now is reduced because of the current situation. And of course the victim of all of this situation is the developing economy. Yeah. And we see that the current situation, yeah, if we look at from the many studies from the international institution that we face what we call it lower growth, yeah, lower growth, and that is I think very interesting to discuss, and especially the impact. Although you mentioned that the Asia maybe is not experiencing and worse than the other, but it is also concerned because the Asia is always regarded as the center of the economic group of the world. Now, looking at the issue of the interest rate in the US, we see that I think if we look at the history of the Fed policy rate, we can see, and in 24 they increased interest rate by 425 basis points in 24 months. And then in 2015, 225 basis points in 3 years. And now 300 basis points in just only 6 months. I think that is very too speed, and the impact is not very good on the global economy. Yeah, of course the developing countries pay more price on this policy rather than the America. Even though we can see that now the interest rate on the housing in finance, market in US is also now becoming 6%, and previously it's only 2%. So that is the issue that we also concerned on this in this time. And of course, thank you very much that you keep some optimism on Indonesia, especially Jim, that the Indonesia maybe will, even though maybe we are going to be in the recession, or maybe we expect at the very mild, yeah. But that is a very important thing that we should also still cautious with the situation, because we are in the globalized world, that we never immune from the impact of the other economy. And of course, we expect that because Indonesia is what we call it the credit economy. That means the higher interest rate will give a lot of impact to the economy rather than to other. And of course, when you mentioned about the appreciation of the coordination between fiscal and monetary sector, it is very interested. And the most important thing is if central bank understand what the fiscal sectors want. So that is, I think, the closing remark. And thank you very much for the very good and very interested and fruitful explanation on the global economic situation now. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Thank you also Pak Mongit. Maaf tadi belum menyapa. Selamat pagi, siang Pak. Terima
kasih. Oh ya, selamat siang. Ini tahapan lama ini.
Yeah, thank you very much Pak Mongit, and also thank you for Pak Edi Purnawan from ISTE ya to facilitate this discussion, and also thank you Bayu for arranging today's discussion.
Okay, thank you very much, Professor Abdul Mongit, for the closing remarks. And now we would like to give token of appreciation for all the speakers. For that, we would like to invite Mr. Rusan Nasruddin, PhD, to go to the front. And please to Mr. James and also Mr. Yan to go to the front of the table. So the first one is for Mr. James. Please give a pause. And the next one is for Mr. Yan. Yes, thank you. And now we are going to have a group photo with all the participants. So please to all the speakers and Mr. Rusan to take a place in front area of the participants. And please to all the participants, come closer. Okay, thank you. Everybody may have a seat. Dear all participants, ladies and gentlemen, that's a wrap up of the Indonesia lecture series. On behalf of FEBUI, I would like to apologize for any inconvenience that happened during this event. It's been a pleasure to host this event. I wish you all a pleasant evening. a pleasant afternoon. Thank you.
Program studi S2 Ilmu Ekonomi didirikan pada 1993, berada di bawah naungan Fakultas Ekonomi dan Bisnis Universitas Indonesia. Program studi S2 Ilmu Ekonomi memiliki visi menjadi pusat pembelajaran ilmu ekonomi jenjang magister yang bereputasi baik di tingkat nasional dan di Asia, sehingga berkontribusi terhadap pembangunan Indonesia dan masyarakat global.
Tujuan dari pengembangan program studi S2 Ilmu Ekonomi ini adalah untuk menghasilkan para tenaga ahli dan profesional yang handal dalam beradaptasi dan melakukan kajian ekonomi untuk menjawab kebutuhan akademik, pemerintahan, dan sektor swasta, serta menghasilkan lulusan yang memiliki tanggung jawab sosial.
Untuk mendukung pendidikan ilmu ekonomi yang berkualitas tinggi, kontekstual, dan sejalan dengan perkembangan ilmu ekonomi global, kami melibatkan dosen-dosen berkualifikasi profesor dan doktor yang terbaik di bidang ini.
Beberapa klaster penelitian yaitu ekonomi moneter dan keuangan, keuangan internasional dan perdagangan, ekonomi regional dan perkotaan, organisasi industri, ekonomi ketenagakerjaan, ekonomi dan keuangan publik, ekonomi sumber daya alam dan lingkungan. Selain memiliki program S2 Ilmu Ekonomi reguler, program studi S2 Ilmu Ekonomi menawarkan program S2 Double Degree, yang artinya mahasiswa dapat bersekolah 1 tahun di dalam negeri dan 1 tahun di luar negeri dan mendapatkan gelar ganda. Program studi S2 Ilmu Ekonomi ditunjang oleh lingkungan yang nyaman, serta didukung oleh tenaga pendidik dari kalangan profesor serta doktor yang berkompeten dalam ranah nasional maupun internasional.
Alumni kami tersebar di seluruh Indonesia, di berbagai kementerian dan lembaga nasional dan internasional. Program studi S2 Ilmu Ekonomi mendukung pembangunan sumber daya manusia yang unggul untuk Indonesia.
Untuk mendukung pembangunan sumber daya manusia yang unggul di Indonesia, program S2 Ilmu Ekonomi banyak melakukan kerjasama akademik di bidang pendidikan antara lain Bappenas, Kementerian Keuangan, Kementerian Perdagangan, Kementerian Perindustrian, Badan Pusat Statistik, Bank Indonesia, dan lainnya.
PPIE itu di dalam kegiatan belajar mengajarnya itu sangat ketat ya, ketat, kemudian juga tegas, menerapkan disiplin kepada mahasiswanya.
Program S2 Ilmu Ekonomi memang sangat menantang dan menyenangkan. Walaupun banyak tantangan, tapi support fasilitas akademis sangat baik, buku dan jurnal sangat lengkap. Fasilitas non-akademis pun sangat nyaman untuk kami belajar. Untuk dosen pengajar tidak perlu diragukan lagi, tentunya mereka adalah ekonom-ekonom ternama. Kuliah di sini juga mendapatkan banyak ilmu dari luar negeri karena banyaknya profesor dari luar negeri yang juga membagikan ilmunya untuk kami. Didukung dengan semua hal tersebut, saya yakin tantangan tersebut menjadi mudah.
Pada tingkat internasional, program S2 Ilmu Ekonomi memiliki 12 mitra aktif dari berbagai belahan dunia, Australia, Jepang, Belanda, dan Amerika. Kerjasama internasional ini mampu meningkatkan kualitas pengajaran dan penelitian. Dalam proses perkuliahan, mahasiswa tidak hanya diperkenalkan konsep dan teori ilmu ekonomi, namun juga dibekali keterampilan lain